What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. Welcome back to What's Next for Markets, the show where we break down big macro themes and market trends with people who help shape them. Today, I'm excited to be joined by Jurrien Timmer, Director of Global Macro at Fidelity Investments. Jurrien's been through it all, from the dot-com bubble to the GFC, COVID, and everything in between. He started his career as a technician, charting market moves with precision, and over time has evolved into one of the most thoughtful macro storytellers in the business. In this episode, Stephen and I speak with Jurrien about how he weaves together technicals, fundamentals, and valuation into a cohesive market narrative. We also dig into today's cycle, where we are, where we might be heading, and how Jurrien sees it all fitting into the bigger picture. It's a wide-ranging conversation with a true market veteran, and I think you're really going to enjoy it. Let's get into it. Good morning, Jurrien. Really excited to have you join us on this week's podcast at such another unique time in market history. You are a student of market history. You've had a 40-year career in the investment industry. You just celebrated your 30-year anniversary at Fidelity. I've known you for several years. Our firm has worked with you for several years. So it's a real pleasure to have you join us today at such a unique time and discuss the big picture and also what's going on in markets these days.
Yeah, it's a pleasure to be here and plenty to talk about, I'm sure.
Yeah. All right. We'll see what we can get through in about a half an hour or so. So you've seen the dot-com bubble, the GFC, COVID, and many other events throughout history. I want to start just thinking big picture. I always ask people, you've seen a lot, and is there a formative moment or market event that has really shaped your approach to investing? You have such a broad scope of what you cover and a dynamic approach. Was there anything you could think of that's really been meaningful and changed how you go about the investment process?
It's a great question. And the other night I was trying to fall asleep, and normally we count sheep when we do that. And I was counting all the bear markets that I've experienced in my career, and I think I'm at number 12. So it does create a benefit that you have experience, and all bear markets are scary as hell, of course, but at the same time, we've survived every single one of them. And just think of the last 5 years or so, or 6 or 7 years. We had that washout in 2018. That was 20% in a couple of months. And then we had, of course, COVID. Then we had 2022. And they're always kind of scary. And one of the things I've learned is, and it's impossible because we're all human beings, we're not robots, but to somehow remain somewhat detached from it emotionally, I think really separates the winners from the losers, right? If you think about investing, it's really math, it's probability and statistics. Market goes up 10, 11% a year. It rises 60, 70% of the time. That means it goes down 30 to 40% of the time. And keeping your wits around about you during that 30 to 40%, I think is what the difference is between people who stay in, hopefully with a diversified portfolio that can help them sleep at night, and those who get out and say, I'm going to sell now and ask questions later. And that's always a recipe for disaster, because even if you got the exact top tick to sell, you still need to get back in at some point. And the challenge is that the market is always repricing faster than you or I can change our portfolio, right? The price discovery, it never sleeps, and it happens way faster than we can react to. And then you get into those positions where you're either reacting too late and you've missed it, or you anticipated it, but too soon, and then you're sitting around with a still portfolio. And I tried to outsmart the market when I was younger. I thought, okay, I've got all these toys here. I've got the resources, and I've essentially just realized that there's just no way to do it. You build a strategic portfolio that has different assets in the right places, and you rebalance into volatility. But beyond that, you need to let the compounding do the magic for you. And market timing is not the way to do it, to the extent that we go beyond just having all the right pieces in the bucket and the secular time frame certainly makes a big difference in there, and I'm sure we'll talk about that as well.
Yeah, that's all very great advice and a great rule of thumb and an excellent mindset that has proven successful over history. And so, in that context, over your 40-year career, what would you say that's changed the most about markets? You know, we keep hearing that things are happening faster, we've got more and better technology, we're inundated with information. Do you think that's changed either the investor mindset, the investor base, or how have you adapted to that?
Yeah, I think that's correct. Over the decades, the price discovery just happens faster and it's disseminated more quickly. And I think that, so in the old days, maybe before I was even in the markets, but like in the 60s or 70s, the price discovery, like you could have a real edge by talking to companies or whatever and you still can. And we do. Of course, we have an army of analysts who does exactly that. But you could take your time at that point, unless there was some macro tape bomb, but on the micro level, things would unfold more slowly. There were fewer ways to get the word out, if it were. And I think now, especially with social media and the hedge fund community that operates in lightning fast speed, the price discovery just happens a lot quicker. And it can be wrong, right? The market is not always right. I mean, think about last November, the playbook that was assumed seemed fairly confident at the time, except for the tariff part, where I think we were all hoping that it was a means to an end and not an end. And these things are not always right, and the market has to reprice, and it does so extremely violently sometimes and very quickly. And so I think that the speed of the market has changed, and there's probably more leverage in the market. You got like the CTAs and you got the high frequency stuff. Those are things that didn't really exist too much a couple of decades ago. Although they might have existed in another form, right? Portfolio
Sure.
insurance in 87. That was like another version of very fast trading.
Yeah, absolutely. So you've been doing this for a while, and it comes out in your work on your videos on YouTube that you do with Fidelity, your weekly posts that you put on LinkedIn for your weekly asset allocation review, that you are extremely passionate about markets and curious. What keeps you curious after doing this for so long?
Yeah, I don't know what the right answer is, but this is such a fun, challenging puzzle to work on. So maybe this is the osmosis of the Fidelity culture rubbing off on me. 30 years ago, I was hired by the then chairman, Ned Johnson, obviously a legendary figure in our business. And even in his final years, he would never lose that curiosity about, like, always ask me questions about the markets, this and that. And I guess that's just something you either have or you don't. But to me, this is a puzzle that you can never really solve, but it's fun to try. And I think having the sense of mission where we have many millions of customers who are relying on us to help solve their financial needs and help them save for retirement. And we obviously have a lot of portfolio managers and analysts who are trying to do that. Being part of that team and to try to give them an edge. Again, there are never any easy answers. And you see people in social media or on the street trying to make those really bold calls. And I've given up on that because the odds of being right, A, are not much better than a coin toss. And B, it's hard to steer clear of the repercussions that even if you're right or even if you're wrong. So I would rather incrementally help investors just make slightly better informed decisions and rooting that in market history. I mean, again, I've lived through a dozen cycles and I'm very fortunate at Fidelity that we have the resources to do this kind of research. And it's just intellectually very challenging, but fun to try to understand how the world works, knowing that history is never going to repeat exactly, but it is going to rhyme. And just looking at a market cycle like today and saying, well, this kind of reminds me a little bit of COVID without the human tragedy, but that sense of unease of waking up almost afraid to turn on your Bloomberg because you don't know what kind of headline is dominating. And 2022 kind of felt like 1994 when Greenspan was raising the cost of capital. And I think that's just something that I think is hard to just read in textbooks. And it's a lot of fun and worthwhile to try to just always keep learning from history and to see if maybe we can peel the onion in a certain way that just helps our investors make better decisions.
So
A lot of the things you're talking about and have mentioned so far fit perfectly in today's backdrop. You're talking about price discovery and hour to hour, day to day. It's moving so fast, and balancing that longer term view versus in your youth when you were trying to time the market. I think those comments and those ideas are just really applicable today, and advice you could give people about the backdrop today and how to see that larger term picture, those secular trends, and how that steadier hand is helping you.
Yeah, and I think this comes back to the detachment part, right? So I ran a fund for 7 years a long time ago, but it was a macro allocation fund that actually was launched right into the teeth of the financial crisis. So that was a really tough go because it was everything either really worked or it really didn't work. And there was really no sense of, okay, a really broadly diversified portfolio is going to win the game at all times. It wins the game, generally speaking, but on days back then when the market was up, I felt like a superstar. And then on days when the market went down, I felt like the biggest failure in the world. And I realized for me personally that I don't have the right temperament to be a portfolio manager. And that's why I'm not a portfolio manager anymore, because you need to exercise a certain level of detachment that when everything is going against you, but you still have a lot of conviction in your thesis, that you stay the course, and that's hard to do. And I would say that probably the biggest mistake many investors make, and it's totally understandable, is that they get out when the reptilian brain takes over, when the losses happen, right? It means behavioral finance, right? And they get out because they just can't take it and they figure, well, I can always get back in. But again, price always moves ahead of the fundamentals, right? Think COVID, right? Market bottomed in March of 2020. And by June, it was making new all-time highs, even though things were not really any better in June in the economy. People were still obviously suffering. And it just shows you the disconnect or the apparent disconnect between price and the fundamentals. And that's because the market's always discounting. And I think so getting out of the attempt to time the market or outsmart the market the temptation is understandable, but the discipline it takes to not do that is very, very hard to come by. And I think it's just because it goes against our nature, right? It's our fight or flight response. So what I do is okay, I'm going to turn my Bloomberg off and I'm going to go for a bike ride. I do a lot of cycling, or I'll meditate. It sounds corny, but things to distance your monkey mind from the markets and just to get a perspective. And most investors hopefully have a financial advisor. It's like we have an army of them. It's okay, call your person at Fidelity or wherever it is and just get that sanity check. Okay, is my portfolio in the right place? And if not, okay, maybe this is an opportunity to rebalance, right? When markets become very volatile, your 60-40 or whatever that balance is might turn into a 50-50 or 70-30. That's an opportunity to rebalance. But it's really hard because it goes against our nature. And I think it's just age, experience, wisdom, just kind of chilling a little bit more than we're inclined to do. And obviously, when you get older, hopefully you have a little bit more wealth, and that helps you hopefully tolerate some losses as well. But it's not one thing, but it's just life in general, right? Finding that disconnect between the mind and kind of the world around you.
One of the things I think that's a challenge about being an investor in and of itself is that you're always chasing the carrot. You're always looking for what's next. You're never done. It's not like you're building widgets and you could say, well, look, I've created 15 of these. My project is done and complete. Is there anything else you do? You mentioned meditation, bicycle riding. Is there other activities you do that kind of helps you get that satisfaction that you can't realistically can get in markets over and over and over?
This is going to sound maybe funny, but one of the most rewarding things I do, so this gets you into kind of the ego mind, constant rumination about everything that can go right or wrong, and just like mindfulness that lets you just keep things in perspective. And for me, actually, cooking is probably cooking and cycling are the most mindful things I can do. And even if I'm by myself, I'll spend an hour in the kitchen cooking a meal that maybe I'll take 5 minutes to eat, but it's that process of just mindfulness. Even like cleaning the house can be very therapeutic. And it's not specifically, okay, I'm detaching from the markets here. But once you know or have a sense that you're in a robust portfolio, and again, that's not necessarily rocket science, right? You're just playing the odds, right? It's like cold cold-blooded math of, okay, these are the odds, and figuring out what kind of secular regime we're in. I mean, I think that's very helpful. That deals with strategic allocation. But if you have a sense, okay, I'm okay, I've got my emergency cash for the next 6 months, I've got a combination of stocks, bonds, maybe gold, maybe Bitcoin, who knows, other assets, then at that point, you just have to trust the process and get your mind out of the way, because your mind can be your own worst enemy. And so whatever it is, it could be going for a run, it could be surfing. For me, cooking is just a very nice way to detach. And also that I like to make charts, right? And so cooking and charting, there's some commonality there, because I like to plate my food because I want to taste it with my eyes before I taste the food. And for me, making really good charts, and I know you make good charts, Michael, as well, is another way of just elevating the creative experience. And that creative experience, it can be a good antidote for just looking at all the numbers on the screen.
No, that's a good point. And Jurrien, I think you're one of the best, if not the best, illustrator of complex economic market data. And that is such an important asset to have as a communicator of markets and macro. I like to do around the house anything from woodworking to fixing an outlet. There's no emotion in that. It's either correct or incorrect. And when it's done, it's done. And then you can move on and put it behind you.
You need to be balanced in life and balanced in your portfolio. Speaking of being balanced and your interests, from a market standpoint, you have expertise in a lot of different disciplines: technical analysis, macro, fundamentals. That's not really common. Oftentimes, technicians are in a silo, macros in a silo. I'd love to hear a little bit about your research process, because your breadth of knowledge and kind of fields that you dabble in is so wide.
Yeah, thank you for asking. And I'm very fortunate to have had this kind of sequence of career sort of evolution that I've had. So I started my career in New York working for a Dutch bank, and I cut my teeth in the bond market. And I think that is a really good set of disciplines to have, even if you're an equity person. Because, like we see this right now, right? I mean, the bond market rules, right? So, the administration was willing to tolerate a bear market in stocks, but oh my God, the 10 years at 4.5, we got to call the tariffs off, So having a background in the bond market was very, very helpful. But I started beyond the bond market. I was really a technician. I still am. And so 30 years ago when Fidelity hired me, they hired me as a fixed income technical analyst. Talk about a very particular silo to be in. And then I evolved from there to be a multi-asset technical analyst. But I learned, and Fidelity, we do a lot of technical analysts. We have a chart room that you've probably seen. We have some great technical analysts that I work with that you undoubtedly know. But I found when I started at Fidelity, and I'm like walking around pitching chart ideas to equity PMs, I had a major case of imposter syndrome. I'm like, I'm drawing lines on charts here, and you got these people running, tens of billions of dollars, mostly on fundamental principles. And like, what am I doing here? And so, this is like 30 years ago. And so I decided, okay, ultimately I'm a storyteller, right? I'm narrating the market. I'm giving the market a voice. I don't have any easy answers. But if I can give portfolio managers even just a slight edge in understanding the backdrop, then I think we can all win. And so I learned that I need to speak their language, basically. And otherwise it's just too obscure. It's too separate. And again, there's a place for that, right? Our technical analysts will look at individual stocks that the portfolio managers own and that are highly rated or poorly rated on a fundamental or quantitative basis. And they'll say, okay, this is highly rated, but the chart looks like hell. Or it's poorly rated, but the chart looks amazing. And so there's like a real niche for that side of it. But I don't do individual securities. I'm just a macro person. But I figured, okay, a chart is a chart. You can draw a chart on anything, right? You can draw a chart on a PE ratio, and that's fundamental, but it's still technical because you're looking at price patterns and historical patterns. So I found that was a good opportunity just to broaden my toolkit. And so I got into the macro fundamentals. You look at the earnings cycles. You look at what do bull markets look like? What do they have in common? How do PE ratios mean revert? And then I would test quantitatively, I would test the technical indicators also to have a sense of how good are they. And as you probably know, like without some context, without having to make some assumption on whether we're in a trending market or a mean reverting market, a lot of the technical signals are just, they end up being a coin toss, right? A 200-day moving average crossover, it's like a 51.49. That's not gonna cut it, right? You have to make some assumptions. So I realized back when I was in New York before Fidelity, I had an evil boss who would say, if you assume things, you make an ass out of you and me. And so I wanted to never assume things, but in our industry, there's no way around it. You have to assume things, right? If you look at fundamental equity valuations through a discounted cash flow model, you got to make assumptions about what is the risk premium, what is the earnings growth, what is the payout. So there's no way around it. You have to develop a thesis and then have, hopefully, that thesis be well supported by the data and historical trends. So it's just part of the evolution of like, okay, I'm not dogmatic about anything. Here's something, let's try it. And if it sticks, it sticks. And I've gone through hundreds and hundreds of indicators, and sometimes something would look really good 20 years ago, like cyclical patterns, and then, or like the Kondratiev wave. That was great until it wasn't. And you just kind of learn. But for me, most of it was driven by, if I'm going to pitch an idea about the role of interest rates or bond yields in the stock market, it's got to be more than just a chart of the 30-year or the 10-year with a trend line. It's got to be more than that. And so it was kind of out of necessity in terms of trying to be relevant to a very large investment firm that makes most of decisions on fundamental terms.
I think technical analysis, one of the great aspects of it, it captures, in a sense, some of the most difficult to capture part of what moves markets, which is behavior. You can't understand behavior looking at a balance sheet or an income statement, but you can certainly pick up behavioral trends and changes in behavior or perception in that, which is why it's so interesting that you can use all of these inputs, which I guess is the goal. Is that what ultimately gives you conviction? And I guess how often do the stars align across all those disciplines?
Not often, but when they do, it can be a home run, right? So for me, the fundamentals tell you what should happen. The technicals tell you what is happening. And because market behavior is a subset of human behavior, that's why cycles repeat, right? And when the markets are trending, you don't need to be a genius. You look at the trend, but when you have extremes, you can get real signals. So just looking at the last week, right? We've had some crazy action in the markets. I've been using the 1998 price analog, long-term capital. I mean, nothing in common with the current cycle. Totally different, but that was an unwinding of very crowded leverage trades, in spread product, right? That was the unwinding of the convergence trade. And this time, of course, it's been the Mag 7 and the rotation there. But the price analog so far has been exact. It's been perfect. And I'm sure that will stop being perfect at some point. Analogs are great till they don't work anymore. But it can be constructive because you had that impulse down 10%, then a violent short covering rally, which we had a few days ago. And actually, that was after the second one. So we were down 20%. Then we had the violent rally. And you go back to the former breakdown point, right? The scene of the crime, right? So if a portfolio manager I work with, not that I get that tactical because we're a long-term oriented shop, but if they're looking at repositioning a portfolio, you want to give them parameters. Okay, we're now retesting the lows. And we've seen price patterns, right? You have that impulse low or impulse high when you have a rally, or impulse low when you have a decline. Then you chop a bunch of water there, and like the initial liquidation or the margin calls have ended. Market tries to find its footing. And then oftentimes you'll have a retest of the low, or even better, a lower low that gets rejected, because that lower low often will produce divergences. And that's where I think the help of technical analysis really shines. And just to give you an example, during the financial crisis, right? All markets were crashing, of course. The impulse low was in December of '08. And so it was high yield emerging markets and equities. Then you had a big rally. Then the S&P made a lower low in March '09, but high yield and EM made a higher low, right? So it's not it's more art than science. But you look for the intermarket relationships and you look for divergences You can look at breadth, sentiment, RSI types of divergences. So let's say we make a lower low in a few weeks. Right now, the percentage of stocks above their 50-day moving average is like 6. If that lower low produces a 50-day of 15 or 20, again, it's not money in the bank, but it gives you anecdotally more sense that's a washout low that is not supported by the internals of the market. And I think that's where technical analysis can really be helpful. And it's hard to put in a model. We've tried to quantitatively model technical indicators, and it works to some degree, but you can never get around just that human touch of, okay, I've seen that before. And boy, I've got 5 waves down, and that 5th wave is a filled new low, not confirmed by breadth or other things. I think that's how you put the mosaic together, and technical analysis can be very helpful in that.
Yeah, I think you bring up a really good point about digging under the surface of the market and looking at breadth indicators. And that has been extremely important over the last several years as we've seen the rise of the Mag 7 and the most concentrated equity index, I think, in history. And so you were getting very different signals if you're looking at the indices versus looking at what's going on under the surface, a little bit probably in the economy too. And so today, if we could kind of jump into the now, there's a great deal of macro uncertainty that is stemming from a great deal of policy uncertainty. The valuations and the earnings outlooks are certainly more uncertain and somewhat path dependent on the policies of the administration. So I imagine today, or I don't want to put words in your mouth, but which of the mandates are you leaning into more in the intermediate term to give you better comfort on the outlook?
So going back to November, of course, we had an election, a fairly decisive one, although it wasn't expected to be that decisive. And so the markets for a while before the election were sitting on its hands, right? I mean, we don't know what's going to happen. It's totally binary, right? Do you go into fossil fuels or clean energy? It's literally one wins, one loses. Then we had the election. It was a sweep, fairly decisive. So the animal spirits playbook got put to use. And I think the hope was that the tariff stuff was a means to an end, art of the deal, and that sort of thing. And so the markets repriced themselves, and then they had to unreprice themselves back in January. And like often happens, right, buy the rumor, sell the news. The market, the S&P equal weighted index peaked in November, and the Mag 7 peaked in December, right? So very shortly after the election. And the dollar peaked in January, very much like it did in 2017, which was the first term. And then, of course, the tariff stuff, that persistent drumbeat of tariffs kept playing, and the markets had to reprice themselves from animal spirits to a slowdown. And then it was repricing itself just very recently from a slowdown to not quite a recession, but kind of something worse than a slowdown, right? So you look at the GDP forecast that we get on our Bloombergs, and the GDP outlook went from like 2.5 to 1.1, right? So that's not a recession, but it is definitely a pretty severe slowdown. And the earnings numbers haven't reflected that yet, but I'm sure they will, right? So earnings grew at 12% or 11% in 2024. They're expected to grow 9% this year. If the GDP growth was cut in half, earnings will have to be cut as well. So maybe we go to 4% or 5% earnings growth, which is not the end of the world. But for a market that's priced pretty highly or was priced pretty highly, I don't know how easy it is to digest that. And so the PEs have come down, of course. The equity risk premium, I look at the DCF model version of it. It's gone from like about 3% to 3.9 or so. So it's definitely moving in the right direction. And so at this point, I think the stock market is anticipating weaker earnings, not negative earnings, but weaker earnings. And I think it's doing that price discovery. And again, we were down 21.5% at the low. So that's a pretty meaningful cut. And the Mag 7 PEs were down about 30% at the lows. But the problem is that if it was just, okay, tariffs, that means X for the CPI, it means Y for earnings, you reprice the markets and then you're done. But I think the question right now is a whole new world order going to take shape, right? So we had the gold standard in the old days, then we had Bretton Woods, then we had Bretton Woods sort of part 2, if you will, where the whole vendor financing model of The US sends their dollars abroad and then they get recycled back into our capital markets. If that era is really ending and we're going to have some sort of mercantilist era where, I mean, the dollar will always be a reserve currency, but its share of world currency reserves is already down to 54%. So maybe it goes to 40%, not the end of the world. But in that scenario, who's buying our treasuries and what does the dollar do? And so the current juxtaposition of the 10-year, which is at 455 and rising, and the dollar, the DXY, just cut below 100. And so that is a really strange thing. And again, that's where the technical analysis comes in. It's like, okay, that's not something that tends to happen, right? Since the financial crisis, whenever the stock market draws down, yields go down and the dollar goes up because the dollar is the world's funding currency. And when you have a squeeze, everyone needs their dollars. We saw that during COVID as well. Now the correlation between the dollar index and the stock market has gone from steeply negative to now slightly positive. And so what does it mean when your stock market's down and the dollar goes down and bond yields go up? Now we're starting to look like an emerging markets economy, right? And so that is a new regime, potentially. It could all be unwinding of leverage trades, hedge funds, basis trade. Like it could be noise, but still, if the administration is serious about a structural regime shift, manufacturing jobs coming back and this and that, we have to think about what that new world looks like. And I think that is a bigger dimension here than just repricing the market based on slower earnings growth and a higher CPI.
These are multi-generational trends that investors are starting to question, and potentially the concern of, is it different this time? If it is, couldn't be larger in terms of its implications.
Yeah, all three of us probably grew up in the same era of the financial markets where the 60-40 model reigned supreme, right? And you never really had to do very much to be more clever than that, right? So 60% S&P, 40% Bloomberg Ag from the late 90s until COVID. I mean, that thing worked like a charm. You got a 9% CAGR, a 9% annualized vol, and you were in the sweet spot on the efficient frontier. And there was no reason to outthink that or to overthink that. But a new secular regime like the one we're discussing, I don't know that the 60-40 is really the best method anymore. You look at what gold is doing, right? Gold is telling you that this could be happening. And we learned, of course, in 2022 that bonds are not always negatively correlated with equities. They can be positively correlated as well. And also we have the Mag 7 and U.S. exceptionalism causing U.S. large cap growth to outperform for now 11 years, right, since 2014. So if it is a larger regime shift, maybe a 60-40 becomes a 60-20-20 or a 50-20-30, where you rely more on sort of hedged equity approaches, right? Market neutral or equity long short, managed futures, gold, maybe Bitcoin, maybe tips, other private markets, maybe not private credit, but private markets in general, other vehicles that are more likely to strip the beta from the alpha or the alpha from the beta. And I think so those are the existential questions that when you think about, again, we're not going to outsmart the market on the near term, but with the right strategic allocation, we can certainly be in a better position to deliver the goods for our investors.
Yeah, one thing's for certain, we've definitely had this nice decade-long move in equities from the lows of market valuations, whether it's 2009, I think we bottomed at some single digit, or I know in 2011, when really U.S. started outperforming the rest of the world. The S&P was trading at a forward multiple of about 11. And by the end of 2021, we had, I think, more than doubled that. So that's been a nice long run, similar to what we had seen during the decades of the 80s and 90s, from low single digits to high double digits. Stephen, I know you wanted to ask about Bitcoin and crypto just as we wrap up the conversation, talking about other ways to manage portfolio risk and diversification.
You've done some great work on Bitcoin, and I'm intrigued by how you approach that, considering it's a new asset class and how it fits into what you were just talking about now, this kind of changing world. I'd love to just hear your thoughts on that, because that is something that a lot of participants in the research world have sidestepped.
Yes. The only crypto I really am interested in is Bitcoin. Ethereum is fine, but that's really, as a TradFi person, right? As a 60/40 traditional portfolio allocator, to me, Bitcoin is by far the most interesting asset out there. Everything else is a VC tech kind of thing, and you can put that on the aggressive growth side of your equity allocation. And it's easy to just put that in a bucket and forget about it. But Bitcoin is really fascinating because it wants to be money. It wants to be a store of value. And I see it as a different player on the same team that gold is on. But gold is just gold, right? Gold is money. It's a store of value. We're not going to the store and transact with gold, but it's a proven store of value. And Bitcoin, I think, is trying that to be that. And I think it is succeeding in being that. But Bitcoin is a bit like a Dr. Jekyll, Mr. Hyde, right? Because it's also a speculative asset. And now that we have a bunch of ETFs that make it easy to buy Bitcoin, I think, if anything, it's become even more of one. So on certain days, it looks like the NASDAQ, and other days, it looks like gold. And you never know which Bitcoin is going to show up on any given day. And it's interesting that Bitcoin and gold have a negative correlation to each other, which I find fascinating, even though they're trying to play on the same team. And so I take an approach, and this is just my personal opinion. I don't give investment advice, but I think there's a place for both on the menu, right? And if you select from the menu, that's up to you. But I view Bitcoin as an alternative asset that could complement the 60/40, probably somewhere in the middle part of the 60/40. So it has attributes of bonds, right? Because that's what gold to me is the anti-bond allocation. Like, I wouldn't buy gold as a diversifier to equities, but I would buy it as a diversifier for bonds, because when you have periods of financial repression, negative real yields, etc., that when you want to have something that maintains its purchasing power, which of course is gold, other assets as well. But I did this 100-year study of a DCA model going into bonds, stocks, diversified portfolios, and I found that the batting average for bonds historically is better than for gold, but the times when bonds do not do well is when gold really shines, no pun intended. And so to me, like, again, that 60/40, maybe that's a 60/30/10 or a 60/20/20. Gold very much takes a place on the 20 side, in my personal view. And I think Bitcoin is like trying to find its place there. But it's like exponential gold, right? It has all kinds of different characteristics, but that to me is the use case from the perspective of a traditional portfolio allocation person. And when I went down the rabbit hole on Bitcoin 5 years ago, we were all locked down during COVID. I'm like, okay, there's nothing else I can do. Let me finally peel the onion on Bitcoin, because like, it takes a good 100 hours to understand it. Like, you can't just sort of casually say, okay, well, what is this? And so I came at it from that perspective as opposed to a crypto native. And one of the things I find on social media, there's a lot of good stuff, but there's also a lot of stuff where if that's where you get your information, you can easily get misled, right? There's a lot of very strongly held but poorly supported opinions, let's put it that way. And so I wanted to, as a service, I guess, to our investor base, look at it purely from that angle. Like, where in a traditional portfolio would Bitcoin live, if it lives anywhere? And so that's what the approach was. And with Bitcoin, a little goes a long way. It has a really good Sharpe ratio, but both the denominator and the numerator are like really outsized, and so you got to make sure that when things do become correlated, and they do get correlated from time to time, that it doesn't add to your drawdown that you're already getting in other markets. And I think that's the challenge, is really portfolio sizing.
I love the steady hand approach to Bitcoin. You don't see a lot of that.
All right, Jurrien, if there's any last words you'd like to share, this conversation, we've covered a lot. Stephen and I really appreciate you taking the time. at a very busy and crazy time in markets. But I'll leave it to you if there's any last words you'd like to share with the audience.
I would just add just two things. These are trying times. They're stressful. It's often not easy to see what is happening in real time. And only after the fact, he's like, oh yeah, this guy blew up over here and that's why this happened. Was it the Chinese selling treasuries or was it the basis trade being unwound? Like, we don't really have the visibility in real time, but the markets have always recovered, sometimes slowly, sometimes quickly. And just having a portfolio where don't have all your eggs in one basket, I think for most investors, and I know you're obviously dealing mostly with a professional audience here, that diversification really, really helps. And for years, there was like, why would I buy international stocks? They don't do anything. Well, now all of a sudden they're helpful, right? Because the Max 7 is getting rotated. And that just leads me to my final point that there are two sources of returns in our portfolio, right? There's the beta and there's the alpha. And there are times when the beta is running really, really strong, like the secular bull market that we've been in since 2009 and that we may or may not be ending soon. There are times when you just don't have that luxury and you got to focus on the alpha, where you lower expectations and you try to dig under the surface to find returns that are not driven by the market's overall return. And my sense is that we are transitioning from, you can just kind of hang out relying on that beta, to maybe having to work a little bit harder to get the alpha, knowing that markets do not always go up above trend. By definition, they can't. Mean reversion is hard to game because you never know where it starts and from what level, but it does always happen.
Jurrien, that is absolutely true. In markets, nothing ever stays the same forever. Thank you so much for sharing your insights and wisdom with us today. I know our listeners took away a lot from this conversation. We both really appreciate your time and look forward to staying in touch. Thanks for listening to this episode. If you've enjoyed the conversation with Jurrien, please be sure to follow him for more of his insights. Follow him on X at Timmer Fidelity for timely market insights, and on LinkedIn by subscribing to his weekly asset allocation review videos. He's consistently sharing thoughtful perspectives on the markets, policy, and long-term investing.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.